And today I have the extreme pleasure of bringing on some friends in the industry from Nationwide. We have Julie Stewart and Tom Duncan, and I'm going to introduce Julie, and then I'm going to hand this off. So luckily, 1 week you guys don't have to listen to myself and Amy ramble on, so to speak. So I've known Julie for a while. She's the vice president of annuity distribution at Nationwide. She's been around, oh God, probably about 17, 18 years of industry experience. Her focus is on safe money solutions for the past decade or so. She also holds her RICP designation, like myself, from the American College of Finance. I would encourage everyone to at least take a look at possibly getting that designation. It's well worth it. And she and I are working here at DMI. Her goal is to help you guys to make sure that you guys have all the access, whether it's to experts, intel, or anything having to do with fixed annuities in the industry. So with that said, Julie, I'm going to hand it off to you, and I'm going to be quiet for a while.
Awesome. Thank you so much, Jim. And I'll just start out by thanking Jim and DMI, and of course, all of you on the line for your partnership and your business over the years. I mean, we know that with COVID, financial education and awareness has really become the forefront for a lot of people. When they're sitting at home, they've got time on their hands, and we know that we came into a really particular situation where it really just shows the urgency for what we do, right? Which is what Jim had said, working in the realm of safe money solutions. We know that in times of economic uncertainty, financial clients look for three things from their financial advisors, and it's constant contact, to have an opinion, and to have an idea. And so here at Nationwide, we try to think about how can we be a great strategic partner to advisors like yourself to provide you with information to help you have ideas to stay in front of your clients, whether it's, information around the regulatory environment, conceptual selling, planning opportunities, or just product information, right? Because there's always just so much going on. And so there's a couple of things I wanted to share with you before I bring up Tom Duncan. On ways that you can plug into some resources from Nationwide that will help you really just build your skill set and maybe have some different things to talk about. So the first thing is our podcast. Nationwide has a podcast called Clarifying the Complex. I like the podcast because it's really bite-sized. I would say that the episodes range from 20 to 30 minutes in length. You can find them wherever podcasts are available. And an example of a podcast would be Roth Conversions. Desiree Buckner from our advanced consulting group actually just recorded an interview about why Roth Conversions, right? Like she kind of talks a little bit about upcoming tax changes, right? And that Roth conversion strategy is really a hot topic. And so she walks through best practices, things that you need to know about taxation for conversions. And it's just a really great way to plug into a podcast that will sometimes have sales ideas. Other times it has retirement income stories. There could be topics on Medicare, health savings accounts, really just a plethora of information that you can plug into, to stay ahead of current events. So Clarifying the Complex is the podcast. And the last resource I'll tell you about is the Advisor Advocate, or what we call, it's a financial blog from Nationwide Financial. So if you go to blog.nationwidefinancial.com, you don't have to log in, but this is a really great resource. It's called the Advisor Advocate. I call it my one-stop shop. I check it every morning because it gives me not only commentary about everything that happened the day before, but it also plugs me into third-party platforms for industry-related news. So it's very relevant to what I'm doing, right, as a wholesaler, but it's also very relevant to the financial professional. And so again, it's a great place to go, have access to current events, economic commentary, different white papers that Nationwide has written, but then also be plugged into third-party platforms and industry-related news in one aggregated platform. So that's at blog.nationwidefinancial.com. And again, these resources are out there to really just help you plug into current events and have access to that information so that you can stay in front of your clients, right? Have that constant contact, have an opinion, have an idea. So with that, I would like to introduce Tom Duncan from Nationwide's Advanced Consulting Group. Tom has been with Nationwide for over 20 years. He is the senior director of our consulting group, and he leads the team specializing in annuities, IRAs, income, and retirement distribution planning. Tom does hold his JD, CLU, and CHFC. So with that, I'm going to bring Tom up to talk with us about the Secure Act and some planning opportunities around that.
Thank you, Julie. And I'm going to share my screen here, get everybody in the right spot, let the electrons flow a little bit. We appreciate everybody letting us join today. And this topic that we talk about, I hope there's not Secure Act fatigue, because we're not going to go through the payout rules and all of the changes that have happened from the Secure Act. That's been done. People are actually utilizing those and living those now. But what I do want to focus on with this presentation are planning-based ideas that you guys can utilize that are live today with your clients. These are the kinds of things your clients are asking for. And the reason I'm confident in that is we see this on our case consultation work. So as Julie mentioned, I lead our IRA and annuity consulting team here at Nationwide for that advanced planning work. And every day, myself and my colleagues are on the phone or exchanging emails with advisors just like you, talking about these very things. And what we want to do is be able to arm the folks that we work with information to be able to go out and then execute on these ideas in a very succinct and straightforward way. And I think what you'll find as we go through these, that there's a theme, and that theme is efficiency. But it's also making sure that you're well armed to have good conversations with those clients, and that you can then articulate to them why this particular planning strategy might be important to them, and then be able to explain the trade-offs that are inherent in any decision that you make, in our industry. So we really want to focus you in on those. That is kind of our framework before we jump into the specifics of what we're talking about. But if we could all just take a moment and do our compliance duty and please read the client's disclosure on the screen. That would be great. There'll be a moment of silence while we all read that disclosure. Thanks everyone for doing that. Our agenda for today is going to focus on really 4 specific things that, while they might not fall into what you see there specifically on the screen, I think you'll begin to see the flavor. We're going to talk about the importance of the non-qualified annuity stretch. Then we're going to talk about the business opportunity that's available with the new Secure Act 10-year payout rule. We're going to then pivot to a couple of different forward-looking planning opportunities to help you have good discussions with individuals and their families about how you can use life insurance to help make up for the loss of the stretch from a family's wealth transfer planning. And then we'll finish up with a review of the efficiency and the effectiveness of Roth conversions and why now may be the time to have a good Roth conversion discussion. Desiree mentioned some additional resources that we've got for you on that topic if you wanted to look at those specifically. But first thing we always want to do is talk about the non-qualified stretch in the context of the Secure Act, because there was still a lot of confusion about what goes on with non-qualified annuity inheritance. because the Secure Act changed so radically how IRAs get left behind. A quick assumption people made, because IRAs and non-qualified annuities are such similar, such similar types of accounts and products. People have equated, okay, they changed the payout options for IRAs, they must have changed the payout options for annuities, and then for non-qualified annuities, and that is not the case. The first takeaway that I have you think about today is that non-spouse beneficiaries, so think adult children primarily, who inherit a non-qualified deferred annuity can still stretch that out. That has not changed. The Secure Act did not change that at all. And the reason that that's important is because the stretch concept can be a huge wealth building opportunity for families who utilize it. But what we see is that most non-spouse beneficiaries who inherit an annuity, non-qualified, they just cash it in right away. And the reason that they cash it in right away is they don't think there's any other payout option. And what we want to arm you with is the ability to have this discussion up front, but certainly even then on the back side, if you happen to be talked to a beneficiary before they cash it in, that maybe there's a better way. Maybe there's a way that we can use this inherited annuity to build lifetime income for yourself, but not limit access. So if you need access to a big lump sum for whatever reason, you can take it, but you don't necessarily have to take it all right now, pay tax on all the gain just to have that access. So it's really critical to be able to make sure that you have this discussion with your non-qualified deferred annuity owners today. How are they going to leave this non-qualified annuity behind? Because one of the things that we certainly see is that many folks will purchase a non-qualified deferred annuity for its income potential for their retirement income. Makes perfect sense. That's what the main purpose of annuities are. But either over time, either they identify that they might not need this annuity for retirement income like they thought they did when they purchased it, or there's at least a realization that some portion, maybe a decent sized portion of this non-qualified deferred annuity is going to get left behind. So even if they do use it for income, there is still some of that portion that will end up being an inheritance. How can a family have that discussion to understand that what their options are to leave that annuity behind in an income tax efficient manner? Because cashing it in all at once is not income tax efficient. That means all of the gain becomes immediately taxable to that beneficiary, no 10% because it's a death distribution. But you lose the ability when that beneficiary cashes it all in for the power of tax deferred accumulation to continue to work for that beneficiary in their beneficial account. Because what the stretch strategy is all about, hopefully you all remember this from stretch IRA discussions, and the stretch non-qualified annuity works the exact same way, is you just take out life expectancy based payments every year. Take the first one within the first year of death, but then you just take it every year and you leave the balance of that annuity growing tax deferred. It's really simple to understand, really simple to explain. It's the execution and the lack of execution that I've just really spent a whole career in a lot of ways trying to get people to understand the power that the stretch can have for a family's wealth building potential. Think of the stretch concept as nothing but a race. It is a race between the rate of return that you can get on the amount of money that remains in the beneficial account, growing tax deferred, versus the percentage equivalent of the RMD that you have to take out. So if our rate of return is 8% 1 year and our percentage equivalent of our RMD withdrawal is 3, you've won the race that year. What we're hoping is that over time you can win that race enough that you build wealth for that beneficiary. And the reason that this is important for families to understand is that this is a very simple way for them to leave behind a significant legacy. And it's simple. Beneficiary just puts this stretch in place, takes out their minimums. Hopefully they get growth. If they need it, they then can go back in and access it for a larger perspective. And for you as an advisor, the stretch concept has 2 benefits. One, you can have a great conversation up front with mom and dad, the owners of these deferred annuities. How are you going to leave this behind effectively? One of the things you're going to want to do when you have that discussion with them is make sure then that this annuity that you would be purchasing or helping them purchase that is going to get left behind is with a company that will allow the stretch to happen. Not all do. Many of the major carriers do allow the non-qualified stretch, but not all do. Some just allow a lifetime annuitization to a beneficiary. With a non-qualified stretch, you have investment participation, or if you use an index product, you're able to use the indices to track to credit interest. It is a accumulation strategy for beneficiaries. And the second place that this has legs for you as an advisor is working with that beneficiary. You could potentially sell them a brand new policy to stretch through. So there's two ways that this strategy can make sense for you as an advisor, and at the same time, you're helping this client and this family and this beneficiary build that intergenerational family wealth that they're looking for. So I would encourage all of you to spend some time looking at the non-qualified stretch strategy. There's lots of information out there from any of the companies. We certainly have some, and we can gift that to you if you would like. But this is a strategy that you can use up front with mom and dad. How are we going to leave this behind? Let's make sure we're with a company that allows a stretch. And you can also use it with beneficiaries when you're working with them. Do you have the right product to stretch through? Quick example of how the stretch works. So let's say you had a non-qualified deferred annuity owner passed away in 2020, left it to their daughter. Pretty typical adult daughter, pretty typical arrangement. That daughter, she makes the election to stretch. She's going to use her life expectancy to take out her required minimum distributions. She has to take her first life expectancy-based payment within 1 year of the date of the owner's death. And I emphasize that 1 year rule, very important. If you guys write nothing down more than non-qualified stretch, please write next to it 1 year rule. That first life expectancy-based minimum RMD has to be taken within 1 year of the date of the owner's death for a non-qualified stretch. Take it within 1 year, then every year thereafter. As we talked about, gain comes out first. Gain will be taxable to the beneficiary, but we don't have to worry about the 10% penalty because it's a death distribution. And then we hope over the years, especially early, we win that race. That beneficiary wins that race. So again, use this stretch strategy as a way to have good conversations up front with mom and dad. How are we going to leave this annuity behind? We've identified this as a wealth transfer. Let's make sure we're with a company that offers the stretch. And then if you're working with beneficiaries, are they in the right product to do the stretch? Our second opportunity that I'd focus you in on does come from the Secure Act. We mentioned this earlier, but just to reiterate, passed in late December of 2019, huge sea change for IRA inheritance. Took our Stretch IRA away. Stretch IRA was a great wealth building tool for families. Worked the exact same way as the non-qualified stretch. It's just you have so many more IRA dollars that are out there. So we've lost that non-qualified stretch for deaths that occur in 2020 or thereafter. What's replaced it is a 10-year payout. So now when an individual inherits it, so again, think it's usually adult children that inherit an IRA. When they inherit that IRA now, except for a few specific circumstances, they're going to have to take they're going to be subject to a 10-year payout rule. And in that payout window, though, they could choose, and we are doing a fair amount of this business now, they could choose a new product for that 10-year deferral period. Because what's required of them is that they have the entire IRA liquidated by the end of that 10th year after the owner's death. But during that time, they do not have any distribution requirement. It's essentially 10-year cliff vesting, if you want to think about it, or cliff payout, if you want to think about it that way. So what we've have made a decision is that we'll still, and are accepting as new business, inherited IRAs in our deferred annuity contracts, including our index products that are subject to this 10-year rule. So if you happen to run across an IRA beneficiary who's going to be subject to this 10-year payout window, but they want a new product or a product that fits their investment needs for this next 10 years, you could consider using an annuity. And one of the things that this is just anecdotal, but I have been told by many advisors is that what they're experiencing is not a lot of carriers are willing to take inherited IRA business that is subject to this new 10-year payout window. So This is something, in a very niche type of planning market, this is something that Nationwide can differentiate itself a little bit. And so if you happen to be working with an IRA beneficiary and they're looking for a new product, we could potentially be a place for you to fit there. Quick example of how the new 10-year rule works for inherited IRAs. We've got an IRA owner who passed away in 2020, left it again to their daughter. That daughter has until December 31st of 2030 to liquidate that inherited IRA. She has no requirement to take annual payments out for that 10-year period. She can take it all at once. She can take a little bit every year. She can take nothing until the end of 2030. And in those cases, if she decides that they'd like some deferral time to try to grow the wealth a little bit more, what can that beneficiary utilize as a product to help them grow during that 10-year time? And we're seeing some nice utilization of deferred annuities as the investment in that inherited IRA for that 10-year period. So that's our second opportunity. Our next two opportunities are even more forward-looking, both springing from the Secure Act. I'd focus you in on the top two rows there. What we're specifically thinking about here is using life insurance for wealth replacement purposes to replace our stretch. And our second opportunity is doing partial Roth conversions over time to be more as income tax efficient as we can for beneficiaries because we've lost the stretch. But our life insurance opportunity really comes down to a comparison, simple math, but a comparison in how powerful the stretch planning concept was. And now that we've lost it for most IRA beneficiaries, what can a family do to make up the difference? So as you can see there on the screen on the left side, if using the parameters that are listed at the bottom, if a family or if a particular beneficiary had stretched out the IRA that they inherited, they'd have $1.4 million gross at the end of that time. Pretty significant. Under a 10-year payout rule, though, even for a maximum of 10-year deferral and then cashing it all at once and then growing it for the remainder of the beneficiary's life expectancy, to trying to make it as apples to apples as we can, we still don't have as much wealth for that beneficiary at the end of their life expectancy under the 10-year rule. We've lost wealth building power with the elimination of the stretch concept. So what can a family do to minimize that wealth transfer loss, if you want to think of it that way? One of the things that we've simple to talk about is utilizing life insurance to help close that gap. Buying life insurance on mom and dad, the mom and or dad, or maybe both, the IRA owners, so that when they die, their beneficiaries of the IRA, who are also now the beneficiaries of their life insurance, get that life insurance death benefit to help close that gap. Pretty simple. Because in our example, there's almost, rounding up, there's almost a $400,000 difference between what the wealth transfer opportunity from the stretch versus 10-year rule. Maybe mom and dad could buy life insurance in that amount or a little bit more, whatever they're comfortable purchasing and able to purchase to help close that gap. Use life insurance to replace the stretch. That's kind of the characterization. So that's our third wealth transfer, Secure Act driven planning-based opportunity to think about using. And then our final planning-based opportunity that is driven by the Secure Act that is proving really popular today, and we're having a lot of discussions about this, is Roth conversions. And the reason Roth conversions are coming up are several. The first of which, just to level set, is that Roth distributions from Roth IRAs to either the owner or the beneficiary can come out income tax free. So that's the driving force. Hey, this is a way to be able to leave a tax-free legacy behind to beneficiaries, or I can use it myself to have income tax-free retirement income. And one of the things that's driving that discussion is the expectation of many of our clients that their individual income tax rates are likely to be higher in the future than they are now. Think of it like tax arbitrage. That's one of the reasons why people consider doing a Roth conversion, is they think their income tax rates are lower today than they will be in the future, So why not take advantage of that lower rate? And from a historical perspective, that can make some sense. We are in a historically low income tax rate environment. So just from that perspective, the likelihood is of increasing income taxation in the future is a little bit more significant because we're in that low income tax rate environment compared to history. Heck, just a few years ago, the highest rate was 39.6. It's now 37. There's been, in decades past, highest income tax rate was closer to 70%. And, historically, it's been much higher on an average basis than it is today. So it just, the likelihood is that for many folks, income tax rates are going to be higher. That makes a conversion, or the Roth conversion planning opportunity, or palatable to folks. They still got to pay tax, and not everybody likes to do that. But if you can pay tax at historically low rates today versus what it could be in the future, that can be beneficial to some people from their perspective. And the planning strategy that folks are gravitating towards, and this is a sea change just in my own experience, is doing partial Roth conversions on an annual basis and doing them over time, not doing a big Roth conversion all at once. Back in 2010, for those of you that were in the business at that point, we had another big spike in Roth conversion activity. One of the things that was driving, there were two things that drove that. Is number one, the elimination of the income limit on Roth conversions, which is great because it opened it up to more people, and that continues today. And then two, back in 2010, if you did a conversion in 2010, you're actually able to split the tax over 2 years. Can't do that today, but that was what was driving a lot of the activity back in 2010. And I say that because one of the things that we saw, at least this was my experience, is that folks were really focused on, when they did those, is doing the Roth conversion all at once. They had a big traditional IRA or any sort of pre-tax account, and they were thinking, I'm just going to convert it all today. Well, there's been an evolution in thinking on Roth conversions, and that doing small conversions over time, just enough to fill up the income tax bracket that they're currently in, but not doing any more to bump them up into that next bracket. Just fill up the bracket that you're in. Doing it over time is more income tax efficient for individuals and their families, especially if folks are doing this for wealth transfer purposes. Instead of leaving behind a pre-tax IRA that the kids were going to stretch, and we saw earlier how powerful stretch can be, either both in the non-qual and in the IRA side when we had it. Instead, what we're going to leave behind is a Roth IRA that the beneficiary will be able to access income tax free. Now, inherited Roths are still subject to the 10-year payout rule, but if beneficiaries follow certain rules, they can take those distributions out, distributions of gain out, and take them out income tax free. So that's our premise. Higher income tax rates in the future. Does that specifically apply to your client? And then who are they doing it for? Their own retirement income or for their beneficiaries? And then doing it in such a way that they are as income tax efficient as possible today by staying in their current income tax bracket, but filling it up, and then not doing $1 more, but doing it over time. That's the premise of our Roth conversions. And now the final thing that I'll bring up to you before we open it up for questions is this. There is a tax rule in the Roth conversion planning sphere, if you want to think of it that way. It can actually end up being an asset gathering tool for you. If you have a Roth conversion discussion with your client, that you and they have to know what their entire IRA universe is. If you're a basketball player like I am, you've all heard the term cherry picking. Hopefully, if you've heard the term cherry picking. There is a mistake that many people make when they talk about Roth conversions and think that they can go in and cherry pick a particular account to convert. And by cherry picking, they can limit or lower or eliminate even taxable amount of that conversion. And that's not the way that the Roth conversion rules work. Instead, you've got to look at the entire universe of a client's pre-tax IRA. So SEPs, simples, traditionals, And you've got to come up with their ratio of after-tax contributions to their total value, and then apply that ratio to any amount that they convert to determine the taxable amount. You have to know their entire IRA universe to be able to find what their after-tax contributions are in all their IRAs, so that you can apply this pro rata rule appropriately to their converted amount. Now, you might be working with their tax professional in doing this, but if they come to you, one of the first things that you want to ask them is, how many other IRA accounts do you have? I know you've got some with me, which is great, but for the purposes of Roth conversion, we've got to know what other IRA accounts you have, and if there's any after-tax contributions in there, to be able to figure out what the taxation is that will be for this conversion. We can't cherry pick. Use this pro rata rule as a way uncover assets, IRA assets that you might not currently be managing. Here's how the rule works. So in our example here, we've got a client with 3 IRAs. They think they can cherry pick. They are going to or want to convert IRA number 2 because it has $20,000 of after-tax contributions, and its total value is only 25. So essentially only 5,000 of pre-tax earnings. And they think they can cherry pick. And if they just convert IRA number 2, they think their taxation is only going to be $5,000. Isn't that great? No. Unfortunately, don't mean to wag the finger, but I'm being the IRS. They're wagging their finger at us all the time and saying, nope. What we have to do is we've got to figure out, in all of the IRAs that you own, Mr. Client, all the pre-tax IRAs that you own, and it's just IRAs that are aggregated together for this pro rata rule, what's your total amount of after-tax contributions in all of them, and then find what that ratio is of after-tax contributions to total value. So in this for this particular client, they've got $50,000 of after-tax contributions because they've got a whole bunch of it there in account number 3 as well. And then their total value is 200. Easy math, because that's the only kind of math that I can do. What's our ratio? 25-75, right? 50% or $50,000 out of 200, 25-75 ratio. So when we go then to convert account number 2, we apply that ratio to the 25,000, and we end up with a taxable amount of the conversion of $18,750, not the 5. Now, I go through that math not so you guys can do that specific calculation. You certainly can help your client do that if they want, but it's to illustrate how important it is to get this right. I have seen this both professionally and personally with some friends who pulled the trigger on a Roth conversion, had other IRAs, and they had they had some that they converted, they thought they were cherry picking, that had lots of after-tax contributions in them, and ended up paying a lot more in tax than they had expected. I don't want you guys to be put in a position where that happens. So that's why we talk about the pro rata rule, but you can use the pro rata rule as a way to uncover assets. Got to know their entire IRA universe, be able to find this ratio. Even if it ends up being their CPA that does this work, you've got to know, you want to bring it to them and use this then to uncover those IRA assets that you might not be working with them on currently. So we have touched on a lot. We looked at the importance of non-qualified stretch planning for non-qualified annuity owners. We know some of that non-qualified deferred annuity is likely to get left behind. How can those owners of those accounts do that efficiently, effectively? Non-qualified stretch is alive and well. Make sure you're with a company that will allow your beneficiaries to do a stretch. And remember that Nationwide does accept non-qualified stretch beneficial business. So if you've got a client or beneficiary that's inherited a non-qualified deferred annuity, they're looking for a new product to stretch through, we can be a place to come to if that product is the right thing for that client. Second, think of the business opportunities that you've got with beneficiaries who've inherited IRAs with a 10-year rule. By and large, that's what they're going to be operating under now. No more stretch IRA for most types of beneficiaries, but there is the ability for those beneficiaries who want to get a 10-year deferral period going, to try to grow as much as possible in a tax-deferred manner. We do accept inherited IRA business subject to the 10-year rule. So that's another product placement opportunity, again, if it's appropriate for that particular client. Third thing to think of is utilize life insurance as a way to replace the stretch. We saw in that simple example, the wealth that was lost, stretch versus 10-year rule for a family. Well, maybe we purchase some life insurance on mom and dad so that the kids can inherit that death benefit, life insurance death benefit at mom and or dad's passing, to help close that gap. And then finally, the Roth conversion discussion. Clients are looking for direction on what will they perceive to be likely rising income tax rates, and that Roth discussion can be one of the ways to answer that question. And remember then, when you're having that discussion, to keep in the back of the mind, are we looking at their entire IRA universe? Got to know that to do effective Roth conversion planning. Can't cherry pick, but we can make sure that they're doing it right. And then maybe there's a place for a new product with one of those new Roth IRAs to think about. So with that, I will close my comments. And thank you, Jim and Amy, so much for having me on. If we're doing questions, I'm happy to stick around. If not, you can always reach out to us here on the Advanced Consulting Group at Nationwide on individual cases. We're happy to help with that. So thanks so much.
No, absolutely, Tom. I really do appreciate this. A lot of good stuff here.